Um, well, thanks again. Thanks, Nadia, for having me on. Always a pleasure to be in your company. And the others, I see a few of you I've met. Maybe one or two that I haven't, but that's okay. Again, my name is Jason with Florida Pro Mortgage. I am a mortgage loan originator here in Tampa Bay. Nadia asked me to come and talk about DSCR loans. Um, DSCR loans are, I've got a couple of notes, but basically the DSCR stands for debt service coverage ratio. And what that is basically it's really only for investment property. You cannot do it on primary residence or a personal property. And the reason is because you're basically qualifying for the loan based on rental income. So you're actually using the servicing the debt. There's a coverage ratio. So if you are most of the DSCR lenders ideally want to see like a 1-to-1 ratio. So it would be if the property is cash flowing. So if your PITI on the mortgage is $2,000 and you're renting it for $2,000, then that would be a 1-to-1 ratio or a 1.0 ratio. If you're not under that, then if you're not there, then you take a rate hit for it, but you can do it. Some lenders will even do a no ratio DSCR. So even if it's not established or it doesn't have, a great rent roll or whatever, you could still potentially use this loan type. What the big benefit I'd say is that there is no income, no employment required in order to use that DSCR loan. So, there are several, just like anything, there's several variables and several factors that they're going to use to rate it from. I don't know. I guess I can share my screen. I did just pull up a rate sheet through one of the lenders that I've done DSCRs before. So I'll kind of give you an idea. Actually, hold on. Nadia gave me a few quick questions too. So, okay. So let me step back a little bit and I'll start start running through her quick list. So again, what it is, DSCR stands for debt service coverage ratio. Um, why an investor might use it? Most lenders will actually cap you out with the number of loans that you can have, like traditional or conventional financing on. And like usually that's 10 loans. So if you have a larger portfolio than that, then you need it needs to be structured another way, or through another entity. So DSCR loan is nice because you get around that. And again, it is no income, no employment needed, just needs a rent roll. Well, actually, I should take that back. Not necessarily rent roll because you may not have renters before you have a property. And if you're trying to buy a property with a DSCR loan, well, you don't have rent yet. So it can be done off of a 1003 rental a 1007 rental appraisal. And then, however, if it is an existing property and you have actuals, then you can use a rent roll. So that might be better than what it appraises. Maybe the appraisal is better. Like I know an investor that rents to his family, and the family is getting a pretty good deal. So in that scenario, you'd have to have a lease, and on a DSCR loan, I know this lender in particular actually wants 3 months of documented rent payments or 3 checks. So the 3 checks could be a deposit check and two months rent or 3 months rent. The other thing, let's see. So, that's like I said, maybe the rent rolls are better. Maybe the rental appraisal is better. Is it good to do a bridge loan than a DSCR? I would say that a DSCR is just an option. Out of a bridge loan, obviously, is going to probably be higher cost, more expensive. Still a great way maybe to tie a property up, to do some improvements on it and everything, but you're probably not gonna, it's a bridge loan for a reason. You don't live on the bridge, you just get over it. and then you move on. So the DSCR is a good option, I would say, to move off of a bridge loan. But again, it's all going to depend on the rates. Big thing with bridge loans is usually they're going to have a balloon where they want to get paid, and it's time for, and that basically it's time for that loan to end. So that is definitely a key factor for bridges. DSCR is certainly a lot more flexible. I'll show you a rate sheet. I'm going to go ahead and share my screen. If I can find it, here we go. So there we go. Everyone see that okay? Awesome. Okay, so this is Home Express is just one of several non-QM lenders that we use. This is their, and actually this is just came out like an hour ago. They sent me an updated price list or their rate sheet. And you'll notice over here on the left is the base pricing. And basically 100% would be the par rate, where there is no it wouldn't be artificially buying the rate down, and you also would not be artificially increasing the rate and getting additional lender credit that you might be able to use towards closing costs, or paying off other costs and fees, or potentially even putting money back in your pocket. So I'm gonna, let's see here. Maybe I can. I don't know how visible this is, but so the par rate on this for their base price for their investor loans basically is going to be right at about probably like 7.4. Okay. So you guys might be aware, essentially 100 basis points is 1% of the loan amount. So hang on here, get a calculator real fast. Okay, so what do we have? This base price at where do you go? There you go. Their base price is actually really not too bad at all. So at 7.5%, it would actually be giving you back or refunding you money at closing. Okay, at 7.375, then it would cost you a little bit to get that rate. Some lenders, you can do an exact rate where you say, I want no closing costs, which is typically when I talk about pricing, I'm always going to quote a par rate or whatever is closest to it, without any, without artificially buying it down, without building any lender credit back in. So let's see, this would basically be 125 basis points. So if we're talking about, so it's essentially, again, 100 basis points is 1% of the loan amount. Okay, so if we are talking about a $300,000 loan, 100 basis points would be $3,000. So 3.25 would be, well, let's see, actually times 1.25, it would actually cost you $3,750 to get the 7.375 interest rate. Okay, but that's the par rate. Here's where the DSCR comes into it. You'll basically notice there are several pricing adjustments that happen. So on a DSCR loan, you'll notice that the highest loan to value you can get is 80%. And there's several factors. So that's based on your FICO score and the loan to value. So if you have a lower FICO, then you basically have a lower threshold for the loan to value, and also this costs you more. Okay, so well, it can either cost you more or again give you money back. So for example, if you are great credit and the highest loan to value, that's actually going to give you more money back towards the loan. So that's a rate adjustment. Same thing, yeah, so actually I've got it backwards, but the lower loan to value and the better your score, basically you're getting credit towards the loan. The higher loan to value and the worse your score, that's costing you. Same thing here, you'll notice there's all these loan level pricing adjustments. The LLPA is what they call. For a DSCR, this is what I was talking about, the ratio. Okay, so if you are over that 1% ratio, you're actually getting a credit back. The 1 to 1.25 is going to be their standard pricing. Okay, standard pricing. And then also so if it doesn't cash flow, 0.75% to 0.99% on the DSCR, you can still do the loan, but you take a big rate hit. Okay. Also, you'll notice you might take, and this is at the top, you'll notice this also has to do with the loan to value. Okay. You also might notice that you take a small rate hit for if it's a 2 to 4 unit or condotel. You can do short-term rental with some of these. This one will do it. High-rise condo, all these things. Okay. So there's a lot of different criteria. So, each one of these little things add up. So normally, if I was looking at this rate sheet, I would actually take your given scenario, put it into a different loan operating system, and crank out pricing from a multitude of lenders. But with this, it at least kind of gives me an idea what their base rate starts at is really going to be like mid sevens, and then depending on the loan to value and the borrower's FICO, kind of gives me a general idea as far as where you might be. Again, I actually do a pricing engine with a given address and specific criteria, then it'll tell me exactly what it'll be. One thing that's also kind of nice about these is they are really pretty quick to get done. Apart from the appraisal, which is still the same standard appraisal that you would get, and as well as in addition to the 1007 rental appraisal. So apart from that, though, they're pretty quick because they're not verifying income, they're not verifying employment. There's still conditions to satisfy, but you can move these things through pretty quick. So that's, I would say, another benefit. Any questions so far?
Would you please talk about some of the guidelines in terms of what they're underwriting to for the clients and the properties, so we know if we can identify a good potential client for this product?
Yeah, I would say for the most part, it's pretty typical. Like, I mean, it's going to be far more broad than like a conventional loan, that isn't going to allow you to use rental income if it's a short-term rental or condotel, so on. So, with this thing, with a DSCR loan, you'll still take, you'll take a rate hit for it, but you can still get it done. And it's an option. Let me see, what else can I tell you about this? One of the other things too, and I don't know if I had seen it on this one, but like if you are a first-time investor, then they will give you, you take a little bit of a rate hit, but the more that you are on some of these, DSCR loans with some of these different lenders, if you're an established investor, then again, you get additional rate credits for it. So it really can be a good option, particularly for an established investor, and still even for a new investor. Let's see here.
So it'd be good to know what the credit scores are before we attempt to use this option.
Yeah. So like if you look at the top here, the main LLPA, this is the FICO. So you can go down to 620. However, you're taking a substantial rate hit for it. And then as the credit improves, not only does the pricing improve, but also you have a lot more flexibility for the basically going to a higher loan to value, putting less down, on a purchase, or even pulling more equity out if you're refinancing. Hopefully that makes sense. Let's see here.
And what are the terms and the amortization periods for the product?
So these are all 30-year fixed. You can do interest only. So for example, interest only DSCR, same thing ratio. So you're taking another, you would take a rate hit for it. Also, they have most of the do have a prepay penalty, which if it is so 3-year or 5-year tiered is basically like a 3-year prepayment payment penalty is kind of standard. So if you pay off the loan before then you are paying a penalty. What I would normally do if somebody thinks that they're going to be cycling it through it sooner than that, then I would suggest a minimum of doing the 1-year prepayment penalty, because what it will do is you basically, if the 1 year you're going to pay anyways, so you might as well have the 1-year prepayment penalty and save it on the front end, and then you will and if you end up getting out more than earlier than that anyways, then you'll pay it on the back end. So it'd be silly to pay for it up front if it's the same cost. So, but let's see here. There are some states that will restrict it, but not that many. Florida certainly isn't one of them. The short-term rentals, they will allow a short-term rental. However, with this lender, I believe that they're still using the same 1007 rental appraisal. I don't think you can use the short-term numbers, which would be great if you could, but that's tough.
I have a question.
Sure.
So, for example, if a person lives in their primary residence and, they want to get a rental property,
Yep.
but they actually want to get a new single family, like a primary residence, and the current one do
Yep.
as an investment property. So let's say they're getting into contract for another one, that will be their primary residence. And
Yep.
this one, the current one, they need to have a contract already, right? They already need to have a contract for the long-term lease. And then they need to have a proof of 3 months payment in advance. And that way, this primary residence can be refinanced for this type of loan.
Yeah, you can. The thing with that, so like if you're currently living in a house, you want to move out of it, turn that into a rental property. And then, buy a new primary residence. So
Mhm.
you could do that. However, I would say, if you currently have a mortgage on the house, then I would leave that mortgage in place, because
Mhm.
that, as when you bought it as a primary residence, that is going to stay, especially if you've been there for a while and the way the rates have been. Like I wouldn't touch that mortgage.
Okay.
Unless you really needed to cash out or something. But normally, even if it was a conventional mortgage you were buying the next house with, either because you wouldn't use a DSCR loan to buy your next house, because the next house is going to be your primary residence.
Right.
I suppose you could use a DSCR loan and refinance your current house and then go pay a small amount or buy the new house outright, or have a smaller mortgage. But I would encourage you, instead of doing that, to keep this as a rental. You can do that if you don't even need the rent roll or the 1007 to do that on the new house, if you have the DTI that works. If you do
Got it.
need it, yeah, if you do need it, then yeah, you need to you'd have to have a lease or a 1007.
Got it. Okay, that
So
makes well, the reason why I was thinking that is because if, for example, you get a second house, but then you're not there with the debt income ratio, so that's why I was thinking.
yeah,
But that makes sense what you said.
yeah. Yeah, so it wouldn't work to buy the new house if that was going to be your primary residence because it's really only investor or rental oriented.
Okay.
But I mean, I do, I see that a lot, and honestly, that's kind of part of my spiel to, especially to young people. Like if you, the way in by and large, the primary way that wealth is created in this country is people will buy a house. And you look at the difference of just the average net worth of a homeowner versus a non-homeowner, no non-homeowner. And it's like, $280,000 to like $5,700. Like it's silly. So I really believe the first thing that you should do is buy a house. If you are, I wish when I first moved to Florida that I bought a house and got roommates. So if you can, do whatever you can to buy a house. Once you
Mm-hmm.
have a house, then really, if you want to grow wealth, start acquiring rentals.
Mm-hmm.
It's not that complicated. You certainly connected with Nadia. She's a fantastic resources, but
Nadia is the best.
Nadia is the best. So, like it's not that hard to make the math work, and over time it just gets better and better. And I mean, I, I'm lucky I got to grow up watching that happen, or watching both my parents have
Mm-hmm.
different levels of success, but both success in real estate. And so I mean, I've got a whole spiel about it, but that really comes down to, buy a house, live in it, buy another house, rent it.
Mm-hmm.
Then buy another house, rent it, and so on. So and the point is, I suppose, is that the DSCR loan is a worthwhile option for achieving those goals. Um, Mainly because on this, your DTI doesn't matter.
Mm-hmm. Yeah, that is
Because
right.
I mean, if you have the cash, it is still credit oriented. So you got to have at least okay credit. And then if you have the cash for down payment, you can buy investment property, start cash
Mhm.
flowing, start building your, savings or investment fund, whatever.
Thank you, Jason.
You bet. Thank you. Any other questions? Did I forget anything, Nadia? Let's see.
No, I think this is really good. Min, do you have any questions?
Mean.
No, just seeing if anybody had any good questions. This is one of the best programs that are out there, and I know actually I think Vika is working with a property that needed to get a gross rent multiplier appraisal to get the appraisal up. So
Yeah.
Do you have any ideas, like when we go do a gross rent multiplier, do you have any recommendations on getting the rentals and getting how to make sure that the appraisal comes out good on those?
Appraisals are kind of tricky from the lender side. Anytime I order appraisal, there's an intermediary, and they are very particular. Like we are not permitted to have any interaction or anything. So anything that I'm giving them is has to go through the intermediary, and it's in their system, in their portal, and everything. If I don't like the valuation, then I got to, submit a request, whatever it's called. So the only thing that I would say is if you are the homeowner, or if you're trying to get, if you're working with the listing agent, whoever, we have some really good valuation tools, and I would say, those are helpful. And I mean, there isn't any reason that you can't put some favorable information and leave it on the countertop, for them to stumble on, and I mean, but from the lender side, we are really required to be very hands off on appraisals. Like I order it and then I receive it, and hopefully it's a good number, but I'm pretty limited in that aspect.
But as a listing agent, like I recently met the appraiser, like shook his hand and kind of
Yeah,
like gave him the documents, explained the situation, and just,
yeah,
and then we got the appraisal that we needed. So I feel like it's an
I agree.
important step that we as listing agents really do not want to skip, because I skipped it for
Right.
one property and it's a disaster. It's still on the market.
Well, I mean, that just like anything, like I feel very particular about my house where I live because of my proximity to the crosstown. And so I live in Riverview, and which has been a great place for us out in suburbia, but I'm very close to crosstown, and honestly, I really think that if I lived any further south or any further east, it would double my commute. And I make great time. And so it's well, what is that worth to somebody, you know?
Mhm.
And so I think that any kind of context that you could give them, certainly you should do, because they might
Mhm.
not know that. They might be there at, on the weekend at 3 o'clock and didn't sit
Mhm.
in traffic on 301,
Mhm.
so
Oh, so we can even underline these kind of things like
yeah.
geographical position and stuff.
I mean, like if you have a one sheet for buyers detailing how great the property is and
Mhm.
why, or what's unique about it, or whatever context you
Mhm.
have, I would definitely leave that on the countertop.
Okay.
And you know what? They can pick it up and look at it and say, "Oh, wow." Or
Mhm.
if they don't, then they don't. But you know,
Right.
at least it's worthwhile information.
Okay. Hey,
You know.
Jason, Neen doesn't know how to unmute her, but she sent me and asked me to ask you a question.
Oh
For
yeah.
the DCR loan, how much you need to put down?
So that I'll go back to the sheet again, but basically that let's see here. Here we go. Can you guys see that still?
Let me see. Yep, I can see it here.
Okay. So basically, you look at the top here, and this shows the FICO versus loan to value. So even at the best FICO score, or the top
Mhm.
bucket, is actually 760. So for this investor loan, it doesn't matter if you're 761 or 815 FICO score, the rate is the same. Basically, 760 and above is the top bucket. And if you're 760 and above, then you can borrow up to 80% against the appraised value.
Okay.
If your credit is not as good, then
Mhm.
like so if you wanted to borrow 80%, you'd have to be above, or 680 or above. Okay.
Okay.
You can be all the way down to 620, but
Right.
you take a big rate hit for it.
Got it.
I mean,
And
this would be many thousands of dollars even on a $300,000 home.
you can email this sheet to us, right?
Yeah, I'm basically going to kind of cut it up and take, I mean, it's Home Express, but
Mm-hmm.
still I don't know that they love me sending it out. So I'll just take their brands off of it and send you the numbers. Uh,
Okay. Yeah.
so you can use it and reference it. And then if you have any question, or if you want me to price if you want me to price a, an individual property or scenario, just
Mm-hmm.
give me a holler or send me an email, and I'll send you back. I can send
Mm-hmm.
you a similar sheet if you like, or we can work through math together, whichever.
Okay. And she's asking another question.
Okay.
If it's a fixer upper,
Yep.
so if it's not the normal house, you can still use this loan or not?
Yeah, you can, but it's basically all off of the present day value.
Okay.
Because and essentially the whatever the current rental estimate would be. So you could,
With a broken house, like with a
well,
house.
I mean, it would still have to be habitable, because
Okay,
it
so
have to be essentially has to be rentable.
got it.
Um, so I would say, light renovation, you still could.
Got it.
Although in that scenario, you might be better off like doing a short-term bridge. And then
Mhm.
once the value is increased, then you could refinance the bridge into a DSCR and be better off. And then
Mhm.
you'd have more money to work with, because
Right.
with a DSCR loan, they're not looking at any after repair value or anything like that. It's
Mhm.
basically just an as is, like, current loan.
And with the short-term bridge, you mean like a hard money loan? Is that what you mean?
Hard money, I mean, would be an option, but there are other bridge loan options. In that scenario, really, I would probably look at a fix and flip loan, or a
Mhm.
renovation loan,
Do
which,
you do those or not?
yeah,
You do
I,
those? Okay.
Yep.
So means so that's gonna be fix and flip or renovation loan, so it's gonna be different from this one.
It would. And I mean, again, you're still going to be paying, I mean, that's still a short-term loan. You're still paying a mortgage. I mean, you take a higher rate for it, but you're going to have more flexibility. And what's nice about
Right.
those is you can finance in some of the repair costs
Mm-hmm. So
and
what you
start
mean,
going off of the after repair value.
the fix and flip and those loans will have a higher rate than this one, but
It-
more flexibility.
Yeah, yeah.
Mhm.
But shorter term. But what's nice, like a fix and flip or renovation loan, is you can. It really has. Most of them are like 70% of the after repair value and like 90% of the 90% loan to value of the current value and 70% of the after repair value. So you can actually put less down, have some money even to do renovations with, and then you complete the renovation and then you could flip it. You could basically refinance it into a DSCR or more even a conventional investment loan. If you, depending on, again, I mean, you're going to get the best rates with the most straightforward approach, which is going to be, even on investment property, still a full doc loan, like a conventional conventional loan. You're gonna get better rates. But if then you got to, again, your employment, your income, your DTI, all
Right.
that stuff comes back into play. So, and I mean, I guess really that's kind of one of the things that I really try to do is, I mean, if somebody feels really strongly about something, they say, "Hey, I want to do this." Well, okay, you've got a plan, and I'm sure you have reason for it. Then let's do that. But if somebody doesn't really know or have a direction, then it's like, okay, well, let's look at the scenario and what's going to be the best option. So you've got that, property that you're looking to, that isn't, far from move-in ready, whatever, and needs renovations or needs a lot of work, whatever it is, then there's certainly better options than a DSCR.
Okay, sounds
But
good.
this might be a good option after you are done renovating.
Right. Okay, sounds good.
All right. Very cool.
Hey,
Well,
could you
yeah.
please speak to working with buyers that are buying established rentals? How is the underwriting and the guidelines going to be applied to a property to establish income?
So I know that with this lender, there needs to be an existing lease and they want 3 months of rent payments or 3 checks. So if you are buying a rental from an existing investor that is a current, is currently has current renters in it, then you could still do that. Basically you would you would have an existing lease and then you would probably need an addendum or you would need a new lease for them to sign, but you would still have you'd be able to document the rent checks that they had paid. I mean, you may be able to get that from the seller, but if you are, however, the renter is paying for it, they should also still be able to document that through their own bank or financial institution. So they can show, that what the rent has been, as long as they have 3 months and then a lease. So either a takeover lease with with an addendum or a new lease, then shouldn't be a problem.
Okay, and in terms of expenses, what's included on the expense side when you're coming up with the ratio?
As far as basically principal, interest, tax, and insurance, plus any HOA, CDD. If you are if you have a property manager, it really kind of, I guess, depends on how that is managed. And let's see, because really it's it is supposed to be, it's mainly just the PITI, or if there's any other things like HOA, CDD, other assessments, stuff like that. And then versus the rent.
Okay. And are there any unusual lender closing costs for these products?
The only thing with this is this rate sheet, I'm not sure if you're familiar with how, with the whole borrower paid, lender paid thing works, but this rate sheet basically, because it is, I think that there is no lender paid broker comp in it. So essentially there would be an origination fee that would correspond with the loan amount. I would say likely 2%. So if you were, again, the same 600,000, I mean, the same $300,000 home, there would be an origination fee of $6,000. And then there is, you know, the other fairly standard closing costs. You can, if you want, you can waive the impounds or waive escrows. Again, you take a rate hit for it, or you can collect escrows at closing, which is, you know, so really it's your down payment, closing costs, and escrows are what are the core things that are making up your cash close. On top of that, in this scenario, because it's a borrower paid structure, then you would add an origination fee, which you may or may not, you know, see, or your borrowers may or may not have seen in the past when they're buying other property, particularly primary residence. Let's see. I don't know. Anything else?
I think this sounds good. So we did get to tape this, so I'm gonna go ahead and upload this to our agent portal so that all the agents can see it in the future as well. Do you guys have any other questions?
No, I'm good. Thank you. That was good.
Yeah, well, love to be a resource for any of you guys. Again, Jason with Florida Pro Mortgage. If you want my email, jason@floridapromortgage.com. Simple enough. So let me know if there's any way I can be a resource. And Nadia, thanks again, as always, for having me be a part of your group.
Yep, definitely. And on our agent portal under the vendors, Jason's on there as well. All right.
Thank you. Thank you so much, Jason. Have a great day.
You too. Thank you
We'll
guys.
see you
Have a good one.
soon. Bye.
Thank you guys. See you
Bye-bye.
soon.